what's up, guys? John here. The housing market is going through such a huge change. It's unbelievable. It's happening overnight. Look at this. Mortgage applications fall to the lowest pace in 25 years. The lowest pace since 1997. Mortgage applications fell 14.2% in the latest week, with rates hitting as high as 2006. I believe we're going to see so many unique things happen in this housing market that people are going to be just blown away. They're going to say, oh, there's no chance that could have ever happened, and then boom, it happens. One of which is going to be rents on the decline. I predicted this over the last year, and now we're really starting to see this unfold. All of this information is unbelievable. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on in the housing market. Because the housing market was that place that everyone thought was a safe haven against inflation. And people were disregarding prices and just simply, hey, I can borrow money for 3%. I'm just going to buy everything. And so a lot of people did that. And now the market's changing. And I think that, people that bought deals with a 2.5% or 3% 30-year fixed rate mortgage and they bought it at the right price, they're fine. But it's the ones that overextended themselves and bought something that they simply couldn't afford just because in the back of their mind they were saying the number one enemy is inflation. I want to borrow money at 3%. I want to buy this massive house that I can barely afford. Those people are going to be in trouble. The ones that said, hey, I'm going to move from the city center and I'm going to go out into the suburbs and buy this beautiful, big house, and then they end up losing their job. That could be a bad situation. But one other situation is going to be the multifamily landlord who bought a deal at a 3 cap or a 4 cap, meaning if they paid all cash for the deal, they would make, let's say, for example, it's $1 million property and it's netting $40,000 a year in net income. That would be a 4 cap. And now what's going to happen is rates are skyrocketing, and when it comes time for those investors to refinance out of those buildings and they have rents coming down and borrowing costs going up, it's going to equate to a disaster for these landlords. Here's what's going on. Please hit the like button. Hit the like button. YouTube's going to share this content to educate more people about what's really going on in the housing market. Take a look at this. Mortgage applications fall to the lowest pace in 25 years. In the latest week, mortgage applications fell 14.2% in the latest week, with rates the highest since 2006. A surge in mortgage rates and evacuations due to Hurricane Ian both seriously dampened demand for home purchases and refinances. Now, I don't know if Hurricane Ian would dampen demand and refinances all across the country. Sure, maybe in South Florida. Sure, maybe in Southwest Florida. I would agree with that. But to say that in Texas or New York or Oklahoma or California, I don't think so. I think that most people didn't even really pay too much attention to it, and they were focused on, their own lives. There's a lot going on for everybody. People aren't that concerned about Hurricane Ian unless it's impacting you directly. Now, what I do believe is happening right now is we are going to watch this huge shift across the mortgage market. We're going to see mortgage lenders laying off brokers in numbers in which you've never seen before. We're going to see it through Wells Fargo, Bank of America, Better.com, all the big banks, all the big lending institutions. They're going to begin layoffs again, I believe, over the next few months. Rates are inching even closer to 7%, and buyers have pulled back. The addition of a hurricane in Florida, which prompted widespread closings and evacuations, weighed down the market composite index, a measure of mortgage applications volumes, the Mortgage Banker Association said on Wednesday. The market index plunged 14.2% to 218.7 in the week ending on September 30th. A year ago, the index was 684.5. The big picture, mortgage application activity, which includes purchases and refis, has dropped to the slowest pace in 25 years since 1997. That's because mortgage rates have resumed their march upwards, which has chilled buyer demand as monthly payments are poised to keep rising. Well, borrowing costs, it essentially is going to cost you 40% more on a monthly payment schedule to afford the same property today that you could have bought last year. Of course, it's going to chill buyer demand. Some buyers are taking the rise in rates as a cue to be more patient. They have no choice. Most buyers are simply priced out of the market. Mortgage rates are now the highest that they've had since 2006, but the big drop in applications reported this week may likely recover soon, since the plunge was partially caused by widespread closures and evacuations due to Hurricane Ian. Applications in Florida fell 31% compared to the 14% overall. On a non-seasonally adjusted basis, Joel Kahn, Associate Vice President of Economic and Industry Forecasting at the MBA, said in a statement, the refinance index plunged 17.8% and was down 86% compared to a year ago. The only people that are going to be refinancing over the next year or so will be the people that are losing their jobs, if they can get that refi, and the people that simply don't have the cash reserves to make it to the next 6 months, the next year. We're going to start seeing people, the only people refining are the ones that are using their homes as piggy banks. People aren't going to want to refinance as 7%. They're just not. The index, the purchase index, which measures mortgage applications for the purchase of a home, fell by 12.6% from the previous week. The average contract rate for a 30-year fixed rate mortgage sold for $647,200 or less was 6.75% for the week ending in September 30th. That's up from 6.52% from the week before. For homes sold over $647,200, the average rate for 30-year fixed was 6.14%. The 15-year rose to 5.96%. The rate for an adjusted rate mortgage, an ARM, which comprised of 11.8% of total applications, rose 5.36%. The ARM shared increased slightly from last week to the highest since 2008. Market reaction, the yield on the 10-year was 3.740, fell 3.7%. So this is interesting. This came out today. What if the rental market is the first to break? This is what I've been talking about. I've been saying what we are going to see happen is rents fall. And many people said there's no way rents are going to fall because people are going to be priced out of buying a property. They're going to be forced to rent. But this article, brings some unique bonuses, unique points that support exactly what I was saying. What's going to happen? And that I've been saying, what's going to happen is there's going to be more sellers that miss the market that are going to turn to rent their homes. There's going to be a lot of private equity firms, a lot of large corporations buying up all of these properties that developers and builders have been building all over the country. 1.5 million and 1.7 million homes that they've been building, they're going to turn to rent. Retirees are going to turn to renting out their homes because they don't have the money to make it. You're going to start to see people that are losing their homes potentially into foreclosure as a last-ditch effort. They're going to list their homes for rent. You're going to have all of this new inventory. People are going to start listing their homes for rent. But they say, in addition to this, and I've been talking about this to a different extent, they're saying that what's ultimately going to happen is there's going to be more and more people that simply can't afford today's rents. They're going to be moving back with their parents, bringing in roommates. Of course, people simply can't afford it. They can't afford it. But as people start to do this, you have to ask yourself, as the global rental population, or the U.S. population of renters in America, is saying, you know what, I simply can't afford it. What am I going to do? Am I going to feed myself, or am I going to pay the landlord? There's going to be more people defaulting on rents, sure. But we are going to start to see more people saying, I can only afford to spend $800 a month on rent. I'll either bring in a roommate, or I'm going to downsize, or I'm going to do something else. We're not going to see these high rents stabilize here. They're not going to continue to rise. We're going to start to see a lot of change here. Inflation watchers have focused on pulling back the labor market, but tenants blinking in the face of higher rents might be the first step towards the cooling off the economy. There's been an assumption that before inflation can be tamed and housing prices ease, unemployment must rise significantly. But what if it's the other way around? The Federal Reserve has projected the unemployment rate will rise to 4.4% in 2023, and others have even higher forecasts. 4.4% is the numbers that we had in October and November. There is no way we are going to take our inflation numbers right now, even if we're using the numbers that they're giving us, and bring us to a 2% inflation and taking our unemployment data right now from like 3.6% to 4.4%. The only way we'd be able to draw down inflation would be to take us to like a 2008 level, which is like a 9 or 10% inflation. That I don't think is what a lot of people are ready for. I don't think it's what a lot of people are ready for. But there's no way we're taming inflation at 4.4%. The thinking is that a strong labor market has been pushing up inflation and workers' incomes, which in turn has led to rising housing costs in a world that hasn't provided enough places to live. Elevated rent growth means overall inflation will remain hot. Adding 300,000 jobs in a month with wages rising 5% or more a year is clearly inconsistent with the Fed's 2% inflation target, but there's another way to contain rent inflation. Fewer people renting, soaring rents could motivate people to find a roommate or move back in with family or speed cohabitation with a significant other. Ordinarily, this would be a foolish prediction. People have chosen their current living arrangement for a reason, but the pandemic brought about a historic surge in household formation, and it's possible some of that will unwind as parts of our overheated economy cool. In fact, there's emerging data that is starting to happen within the past couple months. RealPage Market Analytics posted last week that apartment demand in the third quarter was much weaker than we've seen over the past couple years. Due to what appears to be an abrupt halt in household formation, the Monthly Apartment Association reported for rents in September showed a decline of 0.2%. Historically, rents declined a bit in September, so seasonally this isn't a huge surprise, but it's the first time that we've seen monthly rents track what we've seen in 2017, 2019 before the onset of the pandemic. One of the many remarkable things that happened in the first pandemic year is that we've gotten a boom in both home buying and renting. It was an explosion in household formation. 4 million households were added between the second quarter of 2019 and the second quarter of 2020, compared to the pace of more than 1 million a year. Heading into the pandemic, some people decided to leave the city to buy a home in search of more space. Others with family or roommates took advantage of the temporary decline in cheap rents to get their own place or to acquire additional space to use as a home office as remote work surged in importance. While some of that excess household formation has reversed, we still had 2 million more households at the end of the second quarter of this year that would have been based on pre-pandemic trend. When rent surged in 2021, in much of the country, it was mostly calling back some of the declines that occurred in 2020, but rents continued growing this year. We may have hit a tipping point on affordability, considering New York City, where, according to Apartment List, the big increases in rent versus pre-pandemic levels only began in the last few months. Now, I believe, this is for tenants with leases coming due right now, the combination of inflation eating into the budget, rent resetting at a stratospheric level, and recession fears might be too much, spurring them to find a roommate, get a small place. I believe landlords across the country are going to start to be so much more risk adverse. And what I mean by that is that if they have the flexibility, if they can reduce rents, they will do it if they are smart. And they will do it based on terms of getting 3 months, 4 months, 6 months up front for 10% off, for 15% off rent. Like, that peace of mind as we step into uncertain times is worth something. If we look at the data right now with almost 4 million people scheduled to be evicted inside of the next 60 days, over 8.5 million renters right now behind on rent. I mean, it's 1 out of 6 renters in this country is not fully caught up to date on rent. So if you have a 20-unit apartment building and you have 3 or 4 renters that are behind on rent, that's a risk. That is a big risk, knowing that information is going to happen. If you even buy a 20-unit building that's completely vacant and you just list it all at market rent, you're going to have 4 of those doors that are likely behind on bills. It makes more sense to take a rent reduction and get cash up front if you have the flexibility to do so. I think we're going to see more landlords do that. We're going to see that happen all across the country. Landlords are going to start trying to get very, very competitive, very similar to what they've done in 2020 to try to secure renters that are going to pay. All of which is going to be a great landscape for a renter and a bad landscape for a leveraged landlord that doesn't have the flexibility to pivot when times get tough. What do you think about this? Drop below, hit the like button, subscribe to my second channel. It's an interactive call-in show and a podcast. If you need help fixing your credit, we would love to help you. We'd love to help you at CashNow.Video. If you'd like to make money online with a copy and paste strategy, completely free, we'll never ask you for a penny. CashNow.Video/money. And I'm training everyone this week, Monday through Friday, 12 p.m. Eastern Standard Time on Zoom. So if you join at CashNow.Video/money, join the Discord. The Zoom link will be there. And I'll catch you guys in the next video.